Hello, traders. Thanks for tuning in today. I want to talk about risk-free options trades. So, how can you actually get into one of these sorts of trades? Now, market makers price things so efficiently that you can't just directly get into a risk-free options trade, or at least it's very, very rare to find that. And it gets arbitraged out very quickly. With that said, something you can do though is that you can put on a trade that has very little risk. If you're really conservative, you can just risk 1% of your portfolio. And then on top of that, you can then make it a high probability trade. So then you get into that trade, and then after you start making a little bit of money, you adjust the trade, so then you're in a guaranteed profit position. That's the closest thing you got to risk-free options trades. So for example, I might have sold an option for $1, I might have bought an option for $1, right? And then the option that I sold for $1, now it's only worth like 10 cents. And then the option that I bought for $1, it might be worth like, say, $1.90. And so now I still have that option. If I buy back the option for 10 cents, my cost base still goes up by 10 cents. But then what I can do is that I own that option that's worth, say, $1.90. I can sell an option against it for 90 cents. And so I collect 90 cents, but then I have to pay 10 cents to buy back the option that I sold. And so really, though, I'm in a negative 80-cent cost basis position. So I'm going to show you guys today actually how to get into that position. I'm going to show you guys with a real-life trade. I run an options advisory. For those of you who don't know, it's mainly options. Occasionally, we'll be doing things like futures time spreads and futures intermarket spreads and such. But it's mainly options trading. And over there, I did do a trade earlier in IWM last week where I actually turned it into a risk-free trade. I want to show you guys how that actually works, because many people think from the get-go you're in a risk-free trade, which you're not. You slowly get into there by first putting on a little bit of risk and then adjusting the position. Like I said, you buy an option for $1, you sold an option for $1. Well, the option that you sold for $1 now sounds like 10 cents. So you buy it back and they sell something against it to pay for the 10 cents. And now you're in a risk-free position. So I'm actually going to show you guys. I'm going to hop onto the computer. I'm going to show you how that actually works. So let's do it. Okay, so let's look through a trade that we put on. So we put on this trade, a small portion of our portfolio, and then we adjusted it into a risk-free trade. And this is exactly what the subscribers would see when they look at the trade alerts that come out. And that's one of the many things that we do. And so this is one of the things that they would see. And so we did a bullish risk reversal. I'm going to draw out the risk graph for this and go through the cost basis. So here are the strikes right here. And I just say that the expiration for all of them is July 31st. So all the strikes right here. And so here's what it's going to look like from a risk perspective. So I'm going to draw a dashed line, and the dashed line is going to represent the zero. Zero just means you're at break even. You don't make any money, you don't lose any money. If it's above that, then you're going to make money. If it's below that, you're going to lose money. And here's what it's going to look like. It's going to look like that on the downside, because it is a bullish trade, so you do lose money on the downside. And then you, of course, make money on the upside. And if we go back and actually look at the strikes, 130, 136, 148, 154. So, right here, 154, 148, 130, 136. So basically, if the price goes below 136, I start losing money until it gets to 130 where my losses stop. And then I start making money if it goes above 148, but if it goes above 154, my gains stop. And so it's limited risk, limited reward. This trade is nice though because you give yourself a margin between 136 and 148. You don't make or lose anything, so you give yourself a bit of a range right there. Whereas if you just bought the stock every time it ticked down, you would lose a penny every tick that it came down. And so right here, the stock was at about like in the middle right here when we bought it. Or when we put on this trade. Now, if you had chose to instead buy the stock, your payoff diagram would have looked something like this. Would have looked like that, where every ticket goes down, you lose money. Every ticket goes up, you make money. But instead, we chose to put on this other trade because options, for lack of a better word, have lots of options, right? We can do a lot with this trade. So let me walk you through the cost basis. First off, right here, you got $6 worth of risk, then times 100 shares because each option covers 100 shares. So you got $600 worth of risk right there. So all brokers are going to require you to put up some sort of margin, right? So margin is at $600. So margin is $600 right there. And that's the amount you're required to put up when you're selling those options, because you could lose that money right there, and your broker's just required to put that on. Other than that, though, we have to worry about our cost basis. And with our cost basis, we sold the 136 put for 245, and that's why we started losing money below that. We bought the 130 to cap off the risk, so we don't have that downside risk that keeps on going all the way down to zero. So 130, we bought it for 128. So we have, on our cost basis, I'm going to put CB right here, cost basis. We got minus 245 because we got paid that, plus 128. And then we have plus 170. This is going to be for the 148 call that we purchased. So we purchased the 148 call. And then we sold the 154 call. For selling the 154 call, we make 50. All in all, this trade right here, I could calculate it out. You would do 170 plus 128 minus 245 minus 50. And you get a cost basis of $3. So you have positive $3 cost basis. And the way that I explain cost basis to people is that if you bought a stock for $100, your cost basis is $100. If you bought a stock for, say, $100 and you sold a call option against it for $10, your cost basis is $90, right? That's your cost basis. Well, if your cost basis is negative and you hypothetically bought a stock for a negative amount, no matter if the company goes bankrupt, you still end up making money. It's a guaranteed profit at that point. You directly cannot go into that, as I had said, but you can get into an options trade, and then you can adjust some strikes, and you can get yourself into a guaranteed profit position. So right here with what we did with IWM, we had a cost basis of $3, margin we had to put up of $600. And of course, this is what the payoff diagram looks like. If you had put on the options trade, this is what the payoff diagram looks like right here. And then this other one, this is if you just bought the stock. And so what we did then was that after a while, the stock started going up. And so the put spreads lost money because of that. The put spreads that we sold also lost money because of time decay. And so those two things made the put spreads lose money. So what we had then was that we then bought back the put spreads. So we then bought back the 136 put. So we bought it back for 104. And then we sold the 130 put because the only reason we bought the 130 put was so we can limit our risks on the losses if we had any on our 136. Well, then we sold that 130 put because we also bought back the 136. And then we sold it for 43. And so that then means that our cost basis now is at 64. So we did raise our cost basis up to $64, but now our margin requirement is completely gone. So what does that look like then? So I'm going to show you what that looks like. Again, break even, we got our break even here at 0. And then we have a situation where sort of have a trade that looks like that, where we have the 148s right here, and then the 154. And then we make money after 148, but we limit our upside to 154. And our loss right here, 0 is break even. So anything below 0 is our loss. Our loss would then be right there, would be limited to our cost basis of 64, because remember, our margin is gone because the short options are all gone. So it's just our cost basis that we can lose, just $64. Now, this is a trade where we can lose less, but we still lose money. So what did I do with this trade afterwards then? So I'm going to open up a new one to show you what I did afterwards. So now we got a cost basis of 64. What I did afterwards, though, was that I then sold something against the verticals that we owned. And so again, you can own options and sell stuff against the options that you own. So if I own the right to buy Apple at 300, I can sell someone else the right to buy it at 310. And that's really what we did right here. We had the right Now it's erased, but as you could see earlier, we had the right to buy it at 148, and we sold the right to buy it at 154. Well, what if we sold another right to buy it at 154, and then we bought a right further out? And we could totally do that, and this reduced our cost basis even further. So our cost basis went from 64. We then sold and turned into a butterfly spread by selling another 154 call for 106. But of course, we didn't want all that infinite upside risk, so then we bought the 160 call for 33. And so to just do the math on that, you would add 64 plus 33 minus 106, which leaves you with -9. So our cost base is ultimately -9. Now, of course, there's no free lunch, so there's a price to pay for this. I'm going to show you on the risk graph what it looks like. And that's that infinite that upside that you had before, where it could go as high as possible, is now gone. So this is your break even, 0. So if it's below here, you lose money. If it's above there, you make money. And this is what the trade looks like now. So the trade now looks like this, where the 154 strike is right here. And then we actually sold 2 of these. We bought one of these down here at the 160 strike. And then we originally had bought one of these right here at the 148 strike. And so, again, the downside to this trade is that you have this extra risk here they didn't have before, but the upside is, look at the price. No matter what happens to the price, and these arrows just are saying that if it goes to negative infinity or positive infinity, but look at the price. No matter what now, we are in a guaranteed profit position. We are guaranteed, if it goes below 148, which is the minimum gain that we get, which is $9, or if it goes above 160, in that case, we're also still in a minimum gain position of $9. And of course, if it stays in between that, we make even more. But now we're in a completely guaranteed profit position. And so that's what we ultimately did. You got to get rid of that margin requirement. And so we originally had it. We got rid of it within a few days, so within 4 days. And then we got our cost basis down all the way down to -$9. Now, of course, there's a drawback to doing it, and you eliminate some of your upside, where before you had it like this, where no matter how high it went, you would still end up making money. Right here, you do end up in a situation where you don't make as much money, but now you have a negative cost basis, you are guaranteed to make money. It's like buying a stock at a negative price. Now, of course, you can't just go ahead and put on this options trade from the get-go, but what you can do is that you can get into this trade, and then you can adjust some things out, like we did, like buy back the put spread and then sell a call spread against it, and put yourself in a guaranteed profit position. If you guys got any questions about this, just put inside the comments section. Again, I'll link in the description below. We do have a free trial of this service also. Thanks for sticking through the whole video, guys. If you guys have any questions, drop inside the comments section below. And if you guys want to find me elsewhere, I'm on StockTwits, TradingView. You guys can find me on Facebook, right here on YouTube. It's where I do most of my work. Also, I have a trading advisory where we discuss options, but a lot more than just trade alerts. Normally, it would be $99 a month or $999 a year, but we are giving a free trial currently, so link inside the description below if you guys are interested in that. Other than that, everybody, thank you for watching, and go ahead and share this with everybody. We'll see you next time.